Hi, this is Ken Moore with Global View. Thank you for being on the call today. Today's topic is, will President Trump bring chaos or a Reagan revival? So I have a pretty good crowd. I have you all muted, and this is being recorded. The reason we're doing this webinar is that we had several clients ask what we think Trump means for portfolios, and I hope you find it useful. We always fear the future. No matter what time in history you look at, the majority of people held a pessimistic view of what the outcome would be. It just seems that it's cooler to have such a view. So I put this quote up. I have observed that not the man who hopes when others despair, but the man who despairs when others hope is admired by a large class of persons as a sage, by John Stuart Mill. So many people believe life was better in the past, but objectively looking at this, it's easy to prove they're wrong. Matt Ridley was the science editor for The Economist for many years. He wrote a book called The Rational Optimist: How Prosperity Evolves. In this book, he details the consensus view at different times in history and proves today is the best time in history to be alive, and that tomorrow will be better. Many Americans are afraid of Donald Trump because they're convinced he does not have their best interest at heart. Because they believe this, they see his actions in a negative light. And especially because of his brash and often abrasive manner, there's plenty to criticize. He's from New York, after all. It's not my job to change your opinion. I would not presume to do that. It is my job to gain some understanding of what the Trump effect will be on the US and global economy and portfolios. And maybe I can provide some hope. In this presentation, I'll share some of the learning I've received studying persuasion over the last year and a half. I was asked to present some of this to a family office and alternative investment groups in Atlanta in December, and have spoken on this topic to investment consultants at TD Ameritrade. I believe President Trump's impact may be highly impactful because I believe Mr. Trump is a persuader. If you think he's a very effective one, you could use the term master persuader. And I believe we all stand together in the hope that his impact will be a positive impact. Many people believe Mr. Trump will literally try to achieve his stated campaign goal, which was to make America great again. You personally might think this is a stupid goal because America is already great. Because as a client of ours, most of you are in the top 5% of people who've seen their real incomes go up over the last 40 years. But 95% of Americans have not seen an increase. The twin forces of globalization and digitization cause their incomes to fall. It's not hard to imagine that these people were open to an appeal to make their lives better. Witness the success of the unlikely candidate Bernie Sanders. The fact is, they're right. While patent growth has increased 6% or so a year over the last couple of decades, productivity has not kept pace, actually slowing over the last decade. This has caused poor economic growth and led many people to believe we can't get out of it. Moreover, the economic growth resulted has been captured by a few people, and in particular a few companies. To be technical, productivity growth that has resulted has not been diffused or spread out as much as it might. This suggests something is amiss, that regulations have allowed some companies to gain an unfair advantage over competitors. There are many theories on why productivity growth is stalled. No one really knows how productivity growth can be reignited, but there might be cause to be hopeful that a powerful and ethical leader may help that to happen. That is, if the leader acts ethically. Because so few people understand, from my perspective, who Trump really is, which is a persuader, or they believe he is a persuader with poor intentions, his approval ratings at the moment remain low for an incoming president. His ratings are about 45% on average. Because there's a wide disparity, Fox can quote Rasmussen and say he polls favorably, but CNN can use their poll and say he polls unfavorably. Both are right, but the fact is that his numbers are pretty bad for an incoming president. When I spoke in Atlanta, I was one of 3 speakers on a panel. The other 2, hailing from Washington, D.C., were surprised at Trump's victory. I was not. I became intrigued in the topic of persuasion after a nuclear physicist client of mine in January of last year told me he was going to vote for Trump because he's the kind of person who can work with others and get things done. This client liked President Obama's goals, but didn't believe he had the experience and ability to work with others to get anything done. And he especially didn't like Ted Cruz for the same reason. So I started taking Trump seriously as a candidate and started to notice others did as well. Jeffrey Gundlach of Double Line Funds, he's taken over Bill Gross's role as the guru of the bonds, predicted that Trump would be the next president because working class Americans were left behind. Scott Adams of Dilbert made the same prediction and also had a nearly daily blog on this. Scott's writing introduced me to the science of persuasion and caused me, being obsessive compulsive, to devour several books on persuasion by Dr. Robert Cialdini and others, including Scott Adams' book. Scott Adams suggests, and there's an article in the New York Times to confirm this, that Cialdini's advice was instrumental to President Obama's victory in 2012 over Mitt Romney. So I began following the political narrative and noticed that the coal sector and one stock in particular reacted closely to the sentiment of voters. Cloud Peak Energy is a stock identified by Morningstar as the best in the sector. Based on the price movements of this stock, and despite the scandal that would have killed a less persuasive candidate, I believe Trump had an equal shot of winning. You can see this was the Access Hollywood scandal. We had the Comey investigation. Comey dropped over the weekend, Monday, and then you can see that Cloud Peak Energy closed slightly up on the Tuesday when Trump won the election. So the thing is, if Secretary Clinton had won, most likely this stock might have close to a zero value. And I believe there might be some information in this, but I could be deluding myself. The perhaps the most promising thing we've seen so far since Trump's election is that small business confidence has spiked, which might lead you to believe that animal spirits are being reignited. So many people believe, Ray Dalio of Bridgewater, for instance, that Trump will strive to literally accomplish his goal to make America great again. You might think America's already great. I do. But to repeat myself, 95% of Americans have seen their incomes fall. So this spike that you can see here is the highest spike in small business confidence since 1981 when Reagan won. And this is causing a lot of economists and prognosticators to make these analogies. Might be too soon, we'll see. So what about chaos? There were predictions that if Trump win by folks like Mark Cuban, that volatility would spike, that the market would crash. But that hasn't happened. In fact, Mark Cuban's been absolutely wrong. We've seen since November of this year, volatility substantially fall. And in fact, the realized volatility in January of stocks, in other words, the risk, how much they move in a particular day, has been the lowest, one of 5 period lows since 1928, which suggests that the market doesn't see chaos around the corner. So right after Trump was elected, small U.S. stocks in yellow here soared. You can see it was an immediate effect. And that's what you would expect based on the fact that he is a protectionist, nationalist kind of character. And emerging market stocks declined because a big piece of emerging markets is China. So you see there's a huge immediate impact, U.S. small caps, and a negative impact to emerging markets. But what happened is that after Trump came into office, and it didn't look like he was going to wage an immediate, at least, trade war with other countries, that the emerging market stocks also bounced quite nicely. So you see that since the first of the year or so, emerging markets are actually up 7%, and the S&P was up less than 2 over this period I'm showing. So it's really been a global phenomenon that stocks, including international stocks, international emerging market stocks, have all bounced after Trump's election. And it's hard to assign one reason, but we can simply state that this did happen. So what else is going on? Well, kind of important that we were in an earnings recession last year. An earnings recession is a time when the earnings of companies are falling in general or being revised downward. And you can see that last year they were being revised downward. The yellow line shows how earnings were being revised downward. But this year, the reversions continue to come in slightly upward and slightly upward. So most folks use this as a prognosticator of an improving economy. And this is important because usually, most of the time, when you get a new president from another party who comes in, I say most of the time, quite often, there's a recession because when one regime changes to another one, the ball might get dropped on whatever policy metric, whether it's monetary policy, fiscal policy, or whatever, wars in Senate, etc. And that can cause a recession. And recessions are when bad markets happen. So we want to watch that closely that that's not happening. We can't be sure, but it looks like the earnings are picking up. And several of the people that I've talked to in the last weeks confirm this, that earnings are improving, the economy is picking up in the US and globally. And we'll talk about that a little bit more. But I think most revealing of all was an ADP number that came out last week that beat expectations by 50%, a very, very strong number. So last week on Tuesday, I met with the chief economist of PIMCO, Rich Clarida, in Charlotte. I first met him last year in New York City. Rich worked as an assistant Treasury Secretary to Ronald Reagan in 1981. Rich is concerned about Trump's statements, particularly in reference to trade with China. And if there is a potential that there's something major going to happen there. But he believes the global economy is picking up. If you look at these numbers, last year, their forecast for 2016 developed markets, that's US and all international developed markets, was 1.5. This year, 1.75, a slight pickup. For emerging markets, again, a slight pickup. So they think that the world is going to grow this year after inflation at a rate of about 2.75% versus 2.6. Not a lot, but an improvement. The most interesting thing to me that Rich said in this 2.5-hour meeting we had in Charlotte last week is that there is now the possibility, as the US economy in particular moves from the new normal through the new neutral into a period they're calling now insecure stability, that there could be, in fact, a positive economic surprise. We've been worried about for years a negative policy, a negative economic surprise due to a policy misstep. And that concern still remains because we're moving from monetary to fiscal policy, where we're going to have the infrastructure spending. We're moving from globalization to deglobalization, which is to some degree nationalism. It's what happened in Brexit, et cetera. And we have China making a regime change, especially from the export to the consumer-led economy. But with this right tail, the things that could cause it to happen is if we have effective deregulation, if animal spirits are awakened, and nobody really understands this, but if people believe that they can, through their own effort, do better, start a business, whatever it is, this can have a very big impact on the economy. And then there's clearly that we're doing some growth-enhancing fiscal policy. What would typically be considered by most people to be a Democrat's agenda is going to happen. There's going to be infrastructure spending. So another thing I'd like to mention is Nassim Taleb, who wrote Black Swan in 2007, is noted for having predicted the financial crisis. If you think he has any credibility, you should also know he's not afraid of Trump. It's interesting because he was supportive of Bernie Sanders before this. To Taleb, the opposite of fragile or risky is anti-fragile. Taleb said recently in an interview that the new administration looks like the incarnation of anti-fragile people, which means he too, like Rich Clarita of PIMCO, believes there might be more upside in the economy than downside. So before we talk about the outlook, let's talk about, just for a few minutes, who I think Donald Trump is. And it's important that this is not politics. This is just an assessment of what I believe to be the reality of the situation. There are about 40% of Americans who were going to strongly oppose whatever the, quote, Republican candidate, unquote, says. These are the diehards. And similarly, there are 40% who are going to be against it. But there's 20% who are in the middle who are open to persuasion. And quite frankly, I'm in that 20%. As someone who voted against George W. Bush's Iraq War, as someone who is open to whatever the best idea is, who considers himself to be more of a libertarian than anything else, I'm open. I'm not affiliated with a particular party. So that's the end of my politics. But I'll tell you this. Nobody, in my opinion, really understands who this guy is. And the only way that you can is if you read Art of the Deal and if you've studied Persuasion. So in Art of the Deal, Trump tells you that he's going to go big. And so what he means by that is he always starts off hyperbolically. But I think it's also, I need to talk about persuasion just for a minute and what that is. So if you view him through the persuasion filter, as Adam calls it, you're gonna see things a little bit differently. Persuasion is a science. No one is ever rational. We all rationalize, which means when we have a belief, we're far more likely to find facts that corroborate the belief and to ignore or dismiss other facts that refute it. The beliefs that we have are who we are. They are our identity. Anyone's facts that don't agree with our facts are always going to be alternative facts, or they're going to be false. Imagine how powerful you might be if you had the tools to engage people emotionally, and by understanding what motivates them, to use these tools to affect outcomes. If you doubt these tools are real, I invite you to study the work of Dr. Robert Cialdini, Dr. Daniel Kahneman, who've documented this in detail, and Dr. Kahneman won the Nobel Prize for this. I especially recommend Cialdini's Influence, which was written in 1984, and Persuasion, which was written last year. This means, if true, we need to think differently about President Trump if we want to understand what he's going to do. If you're in the 40% group of people, if you're on that team that supports him, you think he agrees with your beliefs, you don't need persuading. You're already on the Trump train. You'll forgive him when his beliefs move out of your camp. He already has your support. That's how he'll get away with a big infrastructure spending bill, which is typically considered to be a Democratic thing, and change the way we look at our foreign allies, for instance. By the way, don't be surprised if there's more talk of higher wages, however that manifests, and comprehensive health care. Maybe he won't call it Obamacare anymore, but it's not going to get rid of. They're not going to get rid of it entirely. And he also believes on the record that everybody should keep, that there should be an existing illness provision. Anyway, if you're in the 20% of people who are not set in their beliefs, you're open to persuasion. But if you're in the people who oppose him, and you think he wishes to harm some groups of people, you're likely to refute him, and persuasion's going to be difficult. The only way you're going to be persuaded is if over time it turns out that he's not quite the monster you think he is. And only time will tell this. So let's look at a recent example of how persuasion works. At the Super Bowl, Lady Gaga was the halftime show. Lady Gaga was very much anti-Trump prior to the prior to the election. A lot of folks speculated that she would use the Super Bowl as a venue to continue her protests. So when she came out with drones and saying, "God bless America," then "This land is your land," and transitioned into fan favorites, this is an example of pacing and leading. Pacing and leading is a persuasion technique where you first gain rapport, then move on to more controversial topics. Dr. Cialdini has proven this is a highly effective persuasion technique. He calls it persuasion. So by persuading, she used this persuasion to get rapport from Republicans with the patriotic songs. And then only after she had this rapport, she moved onto more controversial territory, Born This Way, and ending with Why Can't You Stay? From my perspective, this was brilliant persuasion. And guess what happened? She sold a lot of records because America loved her and she had a very uniting theme. And so there was hardly anything negative said about Lady Gaga. Congratulations, fantastic Super Bowl performance. So, Donald Trump. Politics is emotional. I'm not going to tell you whether this is a good or bad. We don't know. We're in the very beginning stages. But for the purposes of a thought experiment, let's just assume that Trump is a persuader, that he uses persuasion, pacing and leading, just like Lady Gaga did at the Super Bowl. Remember, in his career, he had to lead literally thousands of people, local government officials, contractors, subcontractors, etc., to do what he thought needed to be done. So, what's he going to do in the beginning? He's going to gain rapport. So how is he going to do that? He's going to focus on jobs and stopping terrorism. Specific cases, things people can remember. He said he was going to do this. It's what he's going to do. But he made other promises too. Promises many so-called Republicans don't agree with. So retaining most of the benefits of the Affordable Care Act is going to be one of these, I believe. Ensuring better wages and a huge infrastructure plan that will increase our debt and cause interest rates probably to go up. These are issues Republicans wouldn't support if he didn't use these persuasion techniques. But these are techniques, and assuming Mr. Trump acts ethically, that could cause great change to be effected. Many Republicans choose to ignore the necessities of these things, but in this day and age, we need to make sure that everyone is taken care of. The capitalist system we have today doesn't work for everyone. We need to experiment to learn how to make it work better, and government will have some role in that. This might include some highly controversial measures like a value-added tax on imports, for instance. So let's have a look at the implications of what some of these actions might be. First, this chart shows how much government spends as percentage of total economy since 1947. And we can see that this is the lowest level we've ever seen before we got out of World War II, where we weren't spending anything on our economy. So, which means that maybe we're at a bottom. Maybe we're going to spend more. Maybe we're going to do some spending on infrastructure. And because this is likely to cause debt to increase, and because it's likely to cause interest rates to go up, it's going to be very difficult to make money in safe bonds. So this chart shows what the expected return is for short-term, core, global, and long-term treasury bonds, and it is close to zero. So safe bonds are unlikely to make investors any money over the next 10 years, if you believe anything that Research Affiliates has to say, and I think they're pretty good at this. So safe bonds, zero, but what about other asset classes? So the chart here shows emerging market debt and currency, bank loans, high yield, treasury, index, inflation-protected securities, etc. These types of an emerging market debt have substantially higher returns and are asset classes where we might make money. I'm not saying you can't make money in the US corporate sector either. It's just as an aggregate group in an index, unlikely to do well. One has to be opportunistic. Now, regarding stocks, we see that US large and US small, based on their current valuation, have very low return opportunity, but that international stocks in emerging markets, which are more risky, they have a higher volatility, might have substantially higher returns. So we need to think about this At the same time, we're, quote, making America great again. We need to look outside of the US for investment returns. So, and again, this is on almost any metric we look. So where are we starting out? Where is Trump starting versus where President Obama started first and second term based on valuations? If we take the price divided by 10 years worth of earnings, the Shiller PE in the U.S. it's over 25. But what we can see here is that Trump at a 22.5, just regular trailing 12 PE or future 12 PE, substantially higher than the number that was like 10 or 11 for Obama's first term. There's a headwind. There's a headwind for the U.S. stock market. So looking at this and at what the starting Shiller PE is, the price to 10 years worth of earnings for the U.S., for international stocks, and for emerging, we can then look to see what happened on average 5 years afterwards. And we see that U.S. stocks made diddly squat. International stocks and emerging stocks did very well, but again, they have higher risk. So there's also a great deal of hope for active managers. Investors forget, because our investment lives are so short, most investors accumulate the bulk of their wealth over about a 20-year period. Recent history is not illustrative of the long term. As investors flock into low-cost, market capitalization weighted index funds, and I wrote a blog on this, it's very risky to invest this way, they forget that the recent outperformance of index funds versus active managers is not illustrative of periods when interest rates actually rise. Since the early 80s, we've had interest rates falling, and we've had active funds do poorly. You can see that this, 10% is the underperformance that we experienced over this period. But the last time we had that interest rates went up, we can see that there was a cumulative excess performance from 1960 to 1980 of nearly 70%. So active managers did very well. We know that they did because we have the case of the super investors of Graham and Doddsville, which Warren Buffett mentioned in one of his shareholder newsletters, I think in 1984 or 1985. And these guys, these active value managers, beat the market by over 10% per year. So we think we're going into a period that's going to be similar to this sometime in the very near future if we're not already in it. Now, to show this another way, active managers in rising rate environments beat indexes monthly and annually. So, I looked at, before doing this, what Schwab thinks of Trump's presidency and how hard it is to change Washington. The impact on major budget issues will be opposed by conservatives, and the president has an unprecedented ability to affect markets with tweets and comments. And I agree with that final point, because that is certainly true on a given day. Witness what Gilead Sciences did yesterday when he was talking about hitting the pharmaceutical companies. But this is not very useful. We can't really use this information. So what I prefer to look at is what Rich Clarita at PIMCO said. What he says is that President Trump is likely to pass several things this year. The 90% odds there's going to be a partial repeal of Obamacare with the 50 votes. It's not going to be a full, and so they're going to go in and they're going to change how the exchanges are. And I don't know what else is going to happen, but there's going to be something. There's going to be trade and immigration initiatives that will happen right out of the gate. We already know they had the quote ban on immigrants, and trade issues are coming next. So the key issue here, the one that we're concerned about, is whether or not there is some China is a provisional member of the World Trade Organization. I'm not a lawyer, I'm using the wrong words. So they're a provisional member of the WTO, and if Trump were to say, we'll make you a permanent member if you do this, that would be a good thing. If Trump were to say, we're kicking you out of it, we're scrapping the World Trade Organization overall, that would be a more chaotic event. That would be one that would cause some disruption in the markets potentially, because it would be a signal that we're not trading with one another freely the way we always have, and that could be a concern. Um, so, what are some of the risks? No one can pull a rabbit out of a hat. Persuader, master persuader, con artist. Nobody can pull a rabbit out of a hat. So the thing is that we have this, and I've been studying this for years, and I studied this at the Darla School of Business, where I had a fellowship, and we talked about globalization and trends in globalization, this back and forth, etc. And I've read Howard James, Declasse, and in Declasse, he introduced a term called techno-globalization, technology and globalization, digitization and globalization. These things are happening. That's one of the reasons why people get left behind, and it's not going away. Whatever we try to do to still this, it's not going to completely go away, which means at the end of the day, we need more innovation. So to get this innovation, where does it come from? How do we get it? Well, animal spirits is a good start, but it still remains to be seen how we do it. Now, on a positive note as well, Seth Klarman, famed value investor of Baupost, says stocks may be cast adrift, no longer attached to the valuation grid, but increasingly off it, which means, again, there is substantial opportunity for active managers in this market. So what do we think? Getting to the point. We think that in equity in the United States, it is very risky to own equity index or investment strategies that are closet index like the funds in most company 401ks, which are huge funds that talk about things like R squared. They're risky and overvalued. I'm not suggesting that there's going to be a market crash anytime soon, but I am suggesting that there's very little return possibility in those. And then you need to have exposure outside of the US. International active managers, but a fundamental index international would probably work nicely as well. And in emerging markets, I think you need to have a good active manager who understands what's going on, who's aware of some of the trade war risks, who's willing maybe to take to some degree hedges on currency and etc. For the lower risk things, for bonds and such, we really like the idea of owning credit. So not just high yield credit, but in particular, owning the debt of private companies because they're too small to get lending from banks. And so they have to pay a higher premium, but these are companies that are growing very, very rapidly. These are companies that are excellent companies, many of these. And by doing that, we can get substantially higher returns, and we're starting to do that in clients' portfolios already. We're going to be doing more of it. So we own the credit of these private companies, and we get rid of or largely get rid of the interest rate risk. Also, emerging markets bonds. These are economies that are growing better. There are many very, very good credit bonds in those countries that we can access, and that the credit is improving of those countries. And so we're going to avoid owning U.S. Treasuries, especially long-term Treasuries, except through managers like Jeffrey Gundlach at DoubleLine, who's going to buy and sell in order to try to make some money. So this leaves you with one quote here. Morgan Freeman was in commercials for Hillary Clinton, so he was obviously a supporter of Hillary Clinton. And very recently, he was quoted that he's holding out hope Donald Trump has to be a good president. He can't not be. What I see is a guy who will not lose. And I'd just like to leave you with that thought. If you're upset now, disgruntled, you think that this is not what you thought would happen, and you're just very, very opposed to Donald Trump, the reality is he's president. And so I want to just give you a little hope that maybe there is something in him that is trying to restore order to some degree, to some, maybe not to the degree that everyone would like, but to try to help middle-class workers to get a better income. So we won't know this. We won't know this for a very long time. But with that note, I'm going to go ahead and try to find out how to unmute this and take some questions.
Ron, this is Ron. Can you hear me?
Yes. Hey, Ron, how are you?
Good. This is very good information. What is your plan at Global View? Give me something that I can latch on to. What is your plan in terms of moving forward?
So our plan is this. I mean, there's a couple of things that we've been doing that we're no longer going to do. One of them is we're going to be careful to avoid owning an actual index in emerging markets. So we're concerned that there could be, and I don't think it's going to happen, but there's going to be something of a fight with China. All right, that's one thing that could happen. So it's better off not to own just outright an index of Chinese equities, or even a fundamentally weighted one. That's one thing we're looking at trying to replace. It's been good to have owned it in the last few weeks and this year for sure. That's one thing. We still think, I mean, quite honestly, my personal opinion is that U.S. stocks aren't going to take a hammer in anytime soon. They might do. They've done too well. They're ahead of themselves. They're overvalued. So in an improving global economy, we think that the catching up that's bound to happen in international stocks and emerging market stocks is going to happen over the next 2 or 3 years. That's what we hope and believe is going to happen, as long as there's not a recession. We were very worried. I mean, whenever a transition happens like this, there can be a recession. The handoff from Obama to Clinton would have been a little easier. So it's unlikely to be big policy missteps. But this is a very big change. So if we saw earnings revisions down, if we saw confidence low, if we saw volatility being high, we'd be concerned. But that's not the case. We're seeing the opposite. So that is bullish. But in an overvalued market, we still don't think you should own indexes, and you need to find active managers, and you need to avoid the overvalued stocks. That's the equity, what I think. The bond, what I think, is that we've got to be careful not to own a whole bunch of safe bonds, treasuries. We need to be exposed to credit because we think interest rates are going up. So on the economy, on equities, probably not going to get hammered anytime soon, but there's got to be occasional corrections. There's not a recession on the immediate horizon. We think active management is going to win because interest rates are rising, and it always happens. And then we think we need to be exposed to credit in a different way, and we're spending a lot of time looking at this. I'd like to finalize this presentation by making just a couple of quick points. The first is that major studies confirm advisors add value, whether it's Vanguard, who says that advisors add about 3% per year in value, including 1.5% from coaching clients to avoid losing money that they can't make back by selling at the wrong times and buying at the wrong times. As we studied here, persuasion, we know that this happens. People, all people, however smart they might be, people are irrational. They rationalize, and so they lose substantially to their own behavior. Morningstar says the same thing. They think that advisors can add over 1.5% per year by helping to structure withdrawals and selecting where to invest, where in the world, what types of investments to make. Another source that says it's 3.5%. So our job as advisors, as fee-only advisors who work only for a client or only paid by our client, is best stated by Daniel Kahneman, one of the persuasion experts. Financial advising is a prescriptive activity whose main objective should be to guide investors to make decisions that serve their best interests. And we have a team here, myself, I'm Ken Moore, Joey Hines is another CFP who works with us. He's been by my side for 16 years. Adam Wiles has been here for about 15 years now, I think. Kurt joined us last year. He's in color, that's because he went to Harvard, so he's got a color picture. And then we have a team of planning and professionals and administrative professionals who Amanda's also an accountant, and Erin is working on her CFP. So Christy knows more than I've forgotten about how we work together with Charles Schwab and TD Ameritrade to help our clients be happy. So on that, finish this off and just tell you this presentation is not intended to be investment advice. Past performance is never indicative of future results. If you want to contact me, here's my contact information. And finally, if you don't want to contact me, like a little lower touch, you can visit our website, globalviewinv.com, conflicts, and download our guide on conflicts of interests. Put a lot of time into that. There's a lot of insight that would be impossible for you to gain on your own if you hadn't already worked for one of the big banks, if you hadn't already worked on Wall Street, if you hadn't already known how insurance companies make money, having worked at headquarters of an insurance company on Wall Street. So I think this will be very useful for you, and I invite you to download it. Thank you very much for your time, and have a great day.